Yep. Okay. If you guys can, then we're good. And it's 12 o'clock, so we will get started. So we previously did a webinar on Valley Center, and then we found some due diligence items we didn't like. So we canceled the contract as a negotiating point and also to protect our earnest money, and then go back and retraded the deal. And we got $350,000 credit back from the seller for repairs that are needed. Now, we told everybody that it needs $1 million. Now, I want to go ahead and point out and just go ahead and hit this real quick. That $1 million, that was a high number for negotiating purposes with the seller. And because we already had a lot of that already budgeted in, and I knew that I was shooting for 500 grand, which is why I started at $1 million. And if we could get 500, I would have been thrilled. But 350 still has a great, is a great thing to add back to us, lowers our cost, and gives us more money to go ahead and put into the property. So let me jump on and get started. Sorry about that. So we've got Valley Center, which is on Valley Ranch Parkway in Irving, 3-story office building with a 4-story atrium. You can see the windows around the top. And right above that is a plexiglass roof. Now, this is one of the problems that we found. We found that they said the roof was replaced, and it was, but not the roof over the atrium, which they are referred to as a skylight. We found that there is mold in those tiles, now in those plexiglass tiles. So we do need to replace that roof. Part of me wants to say, you know what, let's save that 300 grand or 200 grand, whatever the number is, and let's save that. And let's hope for a hailstorm to get that replaced by the insurance company. But because when it rains, they say there's a smell in there. Now, I went over when it rained last time, and I did not see any leaks, didn't have any smell or anything else. So this might be something we'll get into and look at closer over time, but it's not something we're going to jump in and do day one. We're paying $9.5 million for the property, $475,000 in closing costs. I'm right on the right side of the screen. Capital improvements, $1.5 million. Now we have $500,000 of that set aside for TIs and leasing commissions. And TIs are tenant improvements. And so unlike apartments where you just do a make ready, in office, a lot of times, you know, it's usually needs paint, usually needs carpet, but you modify that space to meet the needs of whoever that tenant is. So those are tenant improvements. So a tenant will come in and say, I want to lease this space. It's 2,000 square feet, and they ask for a RFP, request for proposal. And so the landlord goes back to them and says, here's what we will do. We will do X amount in rent, X amount per square foot in TIs, et cetera, et cetera, et cetera. And it gets negotiated on that basis rather than an apartment where they just come in and lease. So we need to have that set aside to meet the needs of whatever tenants we come across that want to lease. Now we put a cap on that. If it's too much in TIs, we roll that back into the lease amount. And but bottom line is the lenders wanted to make sure that we had that set aside. We wanted to make sure we had that set aside for TIs and commissions. So we put in $500,000 in there. One of the lenders required us to have $500,000 in there as a floor, meaning that we couldn't tap into it below $500,000. So that was kind of a waste. And we've had, Paul Peebles has been working this, and he's had 3 banks competing against each other for this loan. And I am completely shocked on how good it keeps coming back, a little bit better, a little bit better, a little bit better. And the loan that we ended up getting, I'll get down to that here in a second. Operating, we're putting $300,000 into our operating account. $25,000 is just miscellaneous costs, really just to round off our capital requirement to an even number. Our $7 million loan, some people wanted to go lower, some were right at $7 million. And I budgeted in down here 4.75% interest. That is with a bank loan. Now, we had two banks bidding this and one CMBS lender. CMBS lender is kind of, think of it kind of like Fannie Mae, Freddie Mac. It's not, but it's securitized that way. It's not somebody making the loan and holding on to it. Whereas banks make the loan and hold on to that loan. So in doing that, they want higher interest rates. And so they want higher interest rates because they're going to bank on that. That bank is going to hold that loan, so they want higher interest rates, and they usually want shorter terms. Well, what we've done is we've gone through and negotiated this down. It will be a bank loan, but this bank, rather than 4.75, right now they're at 4.05. Now, depending on where it is when it closes, I'm going to go ahead and plug in right here. Right now, we've got an average of 16.2% per year average. I'm going to change this to 4.15. Every time we do it, I try and add some cushion. Right now, it's at 4.05, but I want to get an extra bip on that to see what it does. Well, changing that, now we're up to 16.8% average return for the investors. Okay, we follow all that. Now let's go over here to our current rent schedule. One of the reasons why we like this property is the rents are low. The average for the occupied is $19.74 per square foot. I would go, actually, you know what, I'm going to go in a quick sidebar real quick. Something that's interesting on office buildings is you might be renting a 1,000 square foot space, but that's your usable square feet. They have a factor on there that they bump up so that you have to pay for your pro rata share of common area. So there's rentable square feet and there's usable square feet. Usable is what you're actually using. Rentable includes your square footage for the rest of the building. So we don't lose anything on what we're renting out, which is a great thing to have. That was a quick sidebar, just to tell you a little bit different about office buildings. The market rent right now for office buildings in that area is about $23 a foot. Okay. All we did, we bumped it up and used our pro forma $21 per square foot. I want to show you a quick thing real quick. Go over here to the 16.8 return. Now, if by chance we could get $23 per square foot, now the returns go up to 24%, which is absolutely ridiculous. I don't think we can get there. At least you can't get there quick, but I want to be conservative. So $21 is a good number, and that still gives a great return. If we can beat it, it's awesome. Another great thing about an office building like this, I'm sorry, I got distracted real quick. Another great thing about an office building like this is each of the leases has bumps in the rent. So they automatically, and it's already in the lease. So they sign a 3-year lease, a 5-year lease, 7, 10-year lease, whatever it is. There are bumps in that. And another spectacular point of office buildings is the leases provide for common area maintenance charges to be billed back to the tenants. For example, if property taxes go up, we pass that on to all of the tenants. Insurance goes up, we pass that on to the tenants. Maintenance goes up, we pass that on to the tenants. So each lease either has a base year, meaning that that's when they moved in, that's what the expenses were, and anything over that they have to pay for, or an expense stop or different things like that. But bottom line is that gives a whole lot of other income, which protects us from the increase in expenses. Okay? So I'm going to jump over here real quick. I budgeted 2% rental increases. I'm sorry, 3% income increases, which is 50 cents a foot roughly, and 2% on expense increases. Well, expenses from year 1 to year 2, I've got budgeted in there at going up $25,000. Well, I did not even take into consideration that we can bill that back to the tenants. So we can have a much higher other income number because we kind of cap our expenses at the level that they are now. Okay, that's a spectacular thing. Just to play around real quick again, that's 16.8% return. What happens if, rather than doing all the calculations, if our expenses stayed the same, which would give us the net about the same, because any increases in expenses we pass on to the tenants, which would increase our other income. And because of that, our expenses realistically stay the same. So if we pass all of that increase in expenses back to the tenants like we're allowed to in the leases, that changes our return to 21.9%. Okay. There's another area that I'm extremely conservative in because I didn't even take that into consideration when I ran the numbers in our PPM here. Okay, so that's another great benefit of commercial leases. Now they're usually longer term, usually 3 to 5 years. Now if we're doing a lot of TIs, we're going to roll that in and have higher rental amounts going in, which means that we spend a little bit more money, but then we have higher rent, and that higher rent gets a higher cap rate, increases the income, which our cap rate drastically increases the value of the building. Here's something else that's interesting. Our current rental rate, the market right now, is $23 per square foot. That's what market is right now. My year 5 market rent is only $23.50 a foot. Okay, so it's already today $23 is market. I'm only budgeting having 50 cents higher per square foot above market as our gross potential rent. So that is huge. There's another benefit of these leases that's not included, is in that other income, we pass on electric expense. So just like RUBS, we do the same thing. We get the electric bill, everybody pays their pro rata share of the electric bill. So if electric goes up, they actually have to pay their pro rata share of that increase. Let's see, any other things on the leases? Now, I am going to sign, Darkor is going to move into the building and take 3,760 square feet. Now, we're putting in there that we're going to pay, just like anybody else, we're going to pay $21 a foot in rent, have 50-cent increases in our lease, plus expense stop, et cetera. So I'm doing that and signing a 10-year lease for us. Now, that $3,760, I'm sorry, the 3,760 square feet, the rent that we pay on that adds, my lease alone adds $1.2 million to the value of the property at a 6.5 cap rate. So my lease alone adds $1.2 million in value, which is huge, okay? Those are great. Look at your questions and see if we have any questions about them. I don't have it, I have to look at it. Oh, okay. I'm sorry, let me do some adjustments because if anybody asks any questions, we can't see it right now. Okay, good. All right, so we have $1.5 million in our CapEx budget. And what we did is we put that toward updating the interior. So the lobby, $160,000, $60,000 for bathrooms, $20,000 for hallways. That's paint and carpet. Trees and landscaping, signage on the building, updating the elevators, which we didn't know about that beforehand either, but luckily I had a lot of cushion in there. $50,000 for lighting to go through and save on electric bills, which helps. It saves the tenants a little bit of money on the electric charge, but it also allows us to raise the rent because then they're looking at a total effective. So we'll change those out to LEDs. Put $40,000 into the parking lot, some repairs and striping. Now the roof and the air conditioner. So the roof, what we mean by that is that plexiglass roof, which is about 300 grand, plus the air handler. The air conditioners are new, but the air handler is original. Now, if we were to replace that air handler, it could be over $400,000. But if we just rebuild it, it'll be about $150,000. And the big thing here is if you have the air conditioner or heater go out in an office building, especially the air conditioner, if that happens, that building gets so hot. Well, all office buildings get so hot that people cannot actually work there, and they get very, very upset that their business shuts down because our air conditioner went down. And if we had to replace that, it could take weeks to get in. So we want to be proactive, get that fixed, just like we do on apartments. Go in and get everything fixed right off the bat. Now, I also put in the TI holdback here of $500,000. The CMBS lender wanted to hold that $500,000 and have that as a floor and not release it, which we said that's horrible. So we went with the bank loan. Difference between the bank loan and the CMBS is also non-recourse, whereas the bank loan is recourse debt, meaning I, Darwin, am personally signing on that loan. So I've got a personal guarantee on that loan. So another reason to make sure that I make all this work. So we actually don't have to put up that big of a TI holdback with the current lender. So we have that extra possibility that we can move that around wherever we want. Okay. So if we take our projected $22.68 per square foot, that means the rent per month, $146,000 or $1,762,000 of total potential rent, which then goes right up here to our pro forma. $1,762,000. So I put in rental income of $1,352,000. So that's bumping it from their current of $1,282,000. So I'm really only bumping it up about $70,000, whereas my rent is going to be well over that. But there are tenants that move in and move out. One of them is a tenant on the first floor that's got great space, which it doesn't bother me that we lose that tenant because now we can go in after we do the updates to the interior. Then we have a better looking building. We're going to get higher rents for that space. So right now we're budgeting 23% vacancy and collection loss. For rental income, other income, which I did not bump up, even though we'll be able to. For our income, all of our expenses, we went through that before. $8 is right in line with market, $8 per square foot. Gives us our net income. Now here's what I want to kick in. This is really dumb. I put in reserves of $250 per unit, and obviously there's not units, it's per square foot. But that's just an extra cushion taken out. TIs and commissions, I put $100,000 in there. Here's the thing. If we have our TI account fully loaded, we don't have to pay this, okay? Now that $100,000, right now we're at 16.8% return. Let's just say I went in there and said, okay, we're only going to have to kick in $50,000. Okay. What happens to our numbers? Now it's a 17.6% return. Okay. And so we want to keep TIs down. We want to make sure that we keep that funded, and that way we can have additional cash flow to the partners. I'm going to jump back a little bit more to these tenants. Half of the current tenants have been there 5 to 15 years. Many of them are local tenants, so we do not anticipate them moving out. We've got very limited competition within 1 mile. The building, this one's cool, is the building is not stick and brick. metal. This is a concrete structure. The building is a concrete structure, so it is solid. It was built in 1985, but the style of it is very classic. It's timeless on their architecture, so it's not going to look dated. Now, I will say that I think that front plexiglass part looks a little dated, so we might take that out. We'll see if that's part of the roof, etc. So that's the only thing that I think dates it, or we update it either way. The other nice thing about me moving in there is David Tuttle on our team has over 20 years experience in office. I've owned numerous office buildings. David's done over 3 million square feet of office deals. For me, it might have been 500,000 square feet of office deals that I've owned. So we do know office. Plus David, who's on our team full time, he is the on-site manager and leasing. So he has that experience to oversee that property. And the big benefit is we're on site. That is an absolutely huge benefit to tenants because they know that they can come in and talk to us anytime. If there's a problem, we can address it right there. We can have relationships with those tenants so that if their lease is coming up, we have a better chance at renewing them. So all that is great. When we update the interior, when we spend this $1 million on the interior, we're really taking this B-class property to have A-class finish out, okay? Not only that, we're having an A-class finish out with B-class rates as far as rental rates. So those are absolutely huge benefits. So here's the important part. What do you get, okay? Right here is the numbers that I use for partners that invest, and it's based on $100,000, okay? $100,000 partner. I hope that's not too bright. Invest $100,000. Year one, you can anticipate a 7.9% return. Now that is, again, it's projected, but I think we're pretty conservative on our numbers. So 7.9 year one. 7% year two. The reason that drops down is we go to an amortizing loan. We have 1 year of interest only rather than longer interest only, so it drops a little bit. Year three back at 8, year four back at 8.6. Year five would be 9% cash on cash plus a 1.4 multiplier. So overall, a 16.8% average return per year over 5 years. Okay, so that is a good solid return with conservative numbers. Like I said, our other income should be much higher because of the pass-through expenses, which would make our net operating income higher, which isn't even in the calculation. We've got $100,000 a year going back into TIs and commissions, which is an absolutely high number, and probably don't even need to spend that because we're funding it up front. Reserves, that's another story. That's extra cushion in there. We have extra cushion in the fact that current rental rates are $23 or $23.50 a foot, $23 or $23.50. So $21 is what we're budgeting for our market rent. Our year five rents, again, our year five market, we're seeing is $23.5, $23.50 per square foot, when right now is $23 a foot. So really, I'm budgeting this as being flat. No increases overall from market if I were to update that to 23. Okay. We've got plenty of cushion in here. I think it's a great return, great building, and we're going to take care of it. And of course, it's going to be the place where we have our office for the next 10 years and our training center. And I've got full recourse on the loan, so I got to make sure it doesn't go anywhere. And so this will be a nice, solid investment. So that's all I had. Do you guys have any questions that you want to throw up here? I'm not seeing any questions. So does that answer everybody's questions? Okay, I think, Nikolai, why a second year return? I guess I go too fast sometimes. Nikolai, I said the second year return went down because we go from an interest only on debt service of $290,000 to an amortizing loan in year 2. So that's why that's why it went down in year 2, is because we have an amortizing loan at that point.
We sell this building in year 5, or we hold on to it?
Now we have a budgeted year 5 sale, and we put that in there just so that we have an end time. There's a possibility that we sell it in 3 years, 5 years, 7 years, 10 years. That's open to whatever the market's doing. However, I'm planning on being there for 10 years with my 10-year lease. So that is something we're not going. Okay. Let's see here. Next question. Can you get more extra money? Wait. I'm sorry, it's too small to read. Can you guys, by putting in a, I'm sorry, I can't read this. I apologize. I just figured out how to do this, a new trick. Can you get more income by putting in a break room with concession machines? Yes, we could. We could put that in there. There's one vending machine in there right now, but quite honestly, if we have space that's not rentable, then we would put that in there. However, if it's rentable space, we're not going to be able to get $21 a foot in a break room or concessions. Just to see what would happen worst case. What if the rent went down? Okay. Went down to 20. Okay, well, if rents went down to 20, just to show you this, again, complete transparency here. If it went down to 20, now it's at a 13.1, but we still have cushion in every other area. We still have cushion. We wouldn't have to, if rents went down to $20, we'd spend less on TIs. We could take that part out of it. So I'm comfortable saying 21, because even with 21, I'm budgeting 8% vacancy factor and 8% collection loss, which would mean this times 0.92. So really, with my collection loss number, my effective rent is 19.32. You follow that? Okay, let me do it again. Market rent is $21. I put in there a vacancy and collection loss. Okay, collection loss of 8% plus vacancy at 8%. That collection loss of 8%, if we take that off the $21, that's $19.32. So even with, even if we move this down to take that 8% collection loss, our effective rents are $19.32. So they're already less than 20. Let's see, next question. Talk about local market, commercial, office, and ability to attract new tenants. Another reason for being on site is people, when they lease space, they want to know that the owner is local, the owner is there to take care of them. And so we can lease this better than the current third-party leasing company who hasn't really even been trying. And the local market in that office is good because we can steal them from higher rental places. And that's all right in David's wheelhouse. He's an expert at all that, so he'll get that thing leased up. Is cost segregation an option on commercial? Yes, it is, and we have not taken that into account at all. Is the $100,000 return after overrides? Yes, that number that I give you on these numbers here, I give you a net number to you. I hate when people do this and they say the property is going to do this. Because the property, just to show you, the property is going to do 22.6% per year average return. After the override and everything, it turns into a 16.8. I don't even look at this number. Every time I do an analysis, the only thing I look at is what is in it for the partner. If I want to make sure we have conservative numbers and make sure it's very good for the partners. And that's what we have here, 16.8. Okay, what's the difference between office suites and executive suites? Very good question. I did not touch on that. Office suites vary anywhere from 1,000 square feet to 10,000 square feet. On this building, I think our biggest tenant is 6,000 feet or so. The executive suites, those are single offices. So think about WeWork or any one of those where all you're renting is one small office. You're talking about 150 square feet, 100 to 200 square feet. And because of that, they're only renting one small space. We can charge $30 per square foot for that.
Because we're charging 400 to 500, 600.
And what that equates to is, let's just say you live in that area and you work out of the home, whatever else. You just need a small office so that you have a mailing address, you have a place to go to, a place to have meetings, etc. Well, you don't want to spend a bunch of money, but you'll spend $400 or $500 on an office, just one small office, so that you have that local presence and a place to go to, etc.
Those tenants, those are tenants.
And David's here with me, and he also put in there that these are also incubator. A lot of times those will be somebody small getting started and building that up, and then they'll take another executive suite, then another one, and then they'll go into a bigger space. That happens all the time. Compare depreciation on this versus same amount invested. Okay. Vicki, I can't read the back end. Okay. Can you please compare the depreciation on this versus the same amount invested in a multifamily deal? I cannot give you that number off the top of my head because multifamily, first off, office buildings are depreciated over 40 years rather than 29 and a half. So that spreads out. Our depreciation is not so good. But we do complete the cost segregation, which takes that from a 40-year amortization, and concrete could be 15 years, or TIs, whatever else. Those are up. When we do a TI, when we lease a space and we do tenant improvements, we amortize the cost of those TIs over the term of the lease. So if we spend $20,000 on CapEx, then we amortize that over the term of the lease. Let's just say it's 3 years. Well, we're writing off just under $7,000 per year on depreciation. So it's different, but it's still good. Is 8% vacancy loss plus 8% collection loss total 16%? Yes, it is. 8% and 8%. It's on there twice. We've got vacancy loss right here of 8%. And we also have collection loss. Now, year 2, I have it at 10 and then going down to 8. So years 3 through 5 is 8 and 8. Year 2, it's 10 and 8, so 18%. Year 1, it's 23.3%. But because we're moving in there, taking extra space, that's going to help out. Okay? So I think this is great. I think that David will have this filled up by the end of next week. So if you want to be involved in this, then definitely reach out to David. David told me to remind you of the automated process. This is a 506D, so we can only take accredited investors. We've done two things. One is we've set this up automated. So you go to darwingerman.com. If you're already an investor, you log in on the top right. If you're not, you click in Invest Now, and there's a form to fill out. That's an investor questionnaire for us to go through to see how you qualify. And then once we have that information, we open up the link to you to go into IMS. You go into IMS, and again, I'm sorry, another login information with IMS, and that's your portal for all your investments. So anything you have with us is on that. So if you have 10 investments on there, you can see all 10 of them, how much you own, how much returns. It's a great tool for you. But on there, you can see opportunities. You click on opportunities, and this property will pop up. It has the private placement memorandum online. It has investor questionnaire. It has all the stuff online. Then, if you want to invest, you still go through and say, click on invest again. And this time you have to go through a third-party accreditation to say whether you're accredited or not. In a 506B, we don't have to do that. But because it's a 506C, we have to have accredited only, then we need to have a third-party accreditation company do that. So then you go in there and you fill out that information, and a third party does your accreditation to say whether or not you're accredited or not. If you are, then you're allowed to invest. All the forms are online. You fill out those forms, DocuSign, no more paper running everywhere. After you sign all those, you'll get the wiring instructions on where to wire the funds to. Nice and, I don't want to say simple, but easier than we've had it with all the paper going back and forth. So that's a great process that we've got started as far as automating it. Is there such a thing as delinquency in office buildings? If so, how is that dealt with?
It's called an aging. It's a 30, 60, 90-day aging. So people may get behind a month or two, but no further.
And are there late fees?
Typically 5%.
Yeah. Okay. In the leases, there's typically a 5% late fee, and that's pretty normal. But since they are businesses, they tend to pay better. But yes, there is the possibility of having delinquent rent.
Basically, we track delinquencies through what's called an aging. And once someone gets 30, 60 days out, then we're knocking on their door because we're on site. So delinquent payments are usually kept to a very nominal amount. In fact, that aging right now is what we call clean. There's no delinquent accounts right now.
And is there such a thing as delinquency for office buildings? So let me go back to, so yes, there is, but it's rare. And if you do have that, you still have the same rights, far as an eviction if they don't pay. Is there such a thing as delinquency? How is that dealt with? Okay. Now, going back to that collection loss, if you're thinking collection loss as delinquency, I'm not looking at collection loss as delinquency. I'm saying collection loss is the difference between the current rental rates and what the leases actually say.
And that could be a rent concession on the front end also.
It could be a rent concession, anything else. For example, right now, our office suites are at $19.74, okay, $19.74. Well, our rental rate is $21 as far as our market. So all the people that are currently there that average $19.74, well, that is a difference of, let me do a quick calculation here. It's a difference of $1.26. So that would mean there's collection loss right now our collection loss currently is only 5.99%. So that's the collection loss currently, and I budgeted in there 8%. Okay. So you see that the current rents are $19.74. We're saying market is $21. So that has a collection loss of $1.26 a foot, which is 6%. Follow that? So that's really what I'm looking at when I mention that. Okay. Any questions? Final questions? Going, gone. Okay, like I said, I think this is a great investment. We're moving our office in there and we're going to be paying rent. And again, our rent increases the value of the property by $1.2 million. So just that, when we lease up those other spaces, it adds additional value. So I really think our numbers are very conservative. We've got a lot in there, and it's going to be a gorgeous building, and we're going to be able to lease it up with not much, I don't say not much problem, but with a lot more activity than we've had. So thank you so much for joining in. I appreciate it. And if you have any questions, reach out to David at darwingerman.com, and he can walk you through everything to get invested in this deal. Thank you so much. Have a great day.